right, let's get this party started, ladies and gents. Get in, get yourself comfortable. We shall get started in a few moments. We will be ready to go in 2 minutes. So just glancing across the watch lists today, Nasdaq having a bit of a bid, up about 0.6% there, or 0.5%. It's strongest of the lot. Dow's really struggling. I think Visa's holding that one back. Commodities on a real tear. Gold's still pushing to highs. Silver's got a 5% day. Even the softs like sugar's just had a big run. I know people don't really often trade sugar, but I like to keep an eye on kind of where the money flows, when the money flow is going. You know, even some of these soft commodities, coffee's ripping, cocoa, not really doing too much, but sugar, oil, trying to get a bid. Oil's been a bit boring, hasn't it, recently? But yeah, gold and silver flying. Cable absolutely on a tear at the moment. Markets at all-time highs, almost. Some of them are. S&P is sort of loitering there. Dow is loitering there. Nasdaq not quite back to where we were, and DAX still there, sitting at all-time highs. It's pretty bullish out there. It's pretty bullish. Anyway, hope you're having a good time in the markets. Hope you're getting what you want out of the markets. I hope that one of the things with these current conditions is that sometimes things can slow down a little bit. You can kind of take a trade. You can think you're on the right sort of move, and then it just stalls out on you. And often you've got to just take that as, okay, fine, it's stalled out on me. Maybe there's another leg to go. But ultimately, if you're trading that momentum ignition, if you're trying to get that A to B type trade, you kind of have to take what you've got. And I think I mentioned this book last week, real old school book. It's kind of been republished. I think it was 1912, I want to say. 1910, so pretty close. Anyway, something here. It's Richard Wyckoff, one of the first books he wrote, aka Rollo Tape was his kind of nom de plume, if you like. He said this: when the tape says get out, I never stop to reckon how much profit or loss I have, or whether I am ahead or behind on the day. And he goes on, obviously, to say it just gets out. That's interesting, right? And we as traders should kind of take that on board, in that, hey, if you're in a trade and the tape's starting to run out of steam, and by the way, tape there is the same as tape now, which is just watching how price is responding to areas. How does it respond to fresh highs? How does it respond after it's had a drive? That's tape reading, just like it was back in the 1900s. So if the price is stalling out, if things are stagnating, you don't glance over at your unrealized P&L and go, I'm not up enough, so I won't take it. You kind of look at it, in its purest form, and say, right, price is stalling, price is stagnating. Should I come out of the trade here? Probably yes, and take whatever that gives you, whether that is up a bit, up a lot, or even down. So anyway, let's get started. Wow, we're 1 minute past already. I've been waffling on about tape. Yes, it's a cool little book that I like books like this. First of all, what are we going to do today? Ladies and gents, welcome to this webinar. We're talking about systematic versus discretionary trading strategies. It's a bit of a boring title, is it? Maybe it is, but it's going to be a good webinar, because this is this kind of thing that unlocks a new level of thinking for you in trading. You probably already know roughly what I mean by these type of things, but it's the thing that can kick things up a gear for you. So systematic versus discretionary trading strategies. A little quote from Michael Marcus here: every trader has strengths and weaknesses. Some are better at systems, others are better at discretionary trading. Spoiler alert, I think there's a sweet spot by doing both. Okay, and that's what we're going to kind of get to at some point. I want to go through a few things first, lay the foundations out. But I think at the moment, especially with the technology we've got and the type of trader you probably are, then there's a sweet spot in doing both. First of all, before we get started, obviously the obligatory disclaimer, ladies and gents. Please understand the risks that come with trading. This is a high-risk business. You can lose a lot. You can make a lot. It's the double-edged sword of leverage. Please just understand what you're doing. And if you want to trade and you want to get involved in it, then please only use money that you can afford to lose, because it is a very risky business. So if we're all clear on that, and we're all happy to go, and you're all happy to still push ahead, knowing the ups and downs and pros and cons with this game, then let's go for it. Okay, so how this will work is, if you're new here, welcome to you. My name is Mark Holstead. Trading for a couple of years, then a couple of decades. I've got a reasonable amount of experience that I can share with you some from my experience, and I also run Traders Mastermind, which is a trading community. So I see new traders or developing traders up and coming. So I feel like I'm in a reasonable position to share with you some stuff like I do on these webinars and share with you some thoughts, some ideas. I definitely don't have all the answers. I don't claim to have all the answers. I don't claim to get every single trade right or any of this nonsense, right? But I will kind of share with you things that I think are going to help you move forward based on what I see and observe with developing traders and based on stuff that I've been doing since 2001. I've placed my first trade actually. Okay, so do your own analysis, research, and homework. Things take time. And I always say that if you're going to make a change, just stick to it for a bit, make a little course correction, observe the results, and adjust and adapt. And the reason I say this every week with the webinar is that very often traders will make a change and it won't work immediately, and they go, that's not working, I'll try something else. And then they're kind of chasing around, they're like headless chicken, nothing's working, and they don't know what to do. So if you do decide to make a change, a little adjustment to your plan, to your strategy, to the way that you focus your methodology in the market, do it for a little bit, adjust, review, and then make tiny little corrections. Okay, so let's get straight to it. And by the way, how we'll operate this, is we will, if you are new here, welcome. If you have been here a while, you know how it works. We run through. I will try to leave some time at the end for your questions. So if you have questions, there's a Q&A section. You're very welcome to put those in. I will help you if I can. But as I said in the beginning, I don't claim to know everything. I know a reasonable amount, because why wouldn't you? I've been in the markets for a couple of decades. But I will help you where I can. If I can't, I will definitely direct you to someone or somewhere, some resource that will help you. So you'll get your question answered. Okay, let's go for it. So let's explore the whole systematic versus discretionary debate, shall we? So let's look at the definitions. I'm not going to spend ages on stuff like that, but we're going to get to the meat as quickly as we possibly can. But we need to kind of lay the foundations, right? The pros and cons of each, common traps, pitfalls, and what I call the hybrid approach, which is what I think is the perfect sweet spot for most of us. Now, some of you may well be in a hardcore systematic, maybe you're running algos camp, and that's fine, but you're probably curious, otherwise you wouldn't have come on here. Most of you, I guess, are probably discretionary. You kind of understand systematic, you understand rule-based, but why wouldn't you? But you're kind of curious to see, well, maybe it's going to help me with my discipline. Maybe it's going to support me in some ways. And yes, that's exactly the kind of thing we're trying to do. And ultimately, my objective with this 45 minutes webinar is to find the sweet spot for you personally. Right. So all the things that I cover, all the examples, all the ideas, all the slides, everything that I talk about today is with one objective of getting you to a point where you can go, okay, that's my rule-based systems. Those are my rule-based systems. Those are my discretionary. Those are my blended, and really leveraging on your strengths and trying to dodge your weaknesses. So bear that in mind as you go through. If you are taking notes, if you are kind of trying to absorb this, use that as your North Star. And that's the way I like to do things. Actually, if I ever read a book or I listen to a podcast or I'm watching something where I'm trying to level up, I think of, okay, what's the thing today that I'm trying to gain from it? I don't want to be distracted and be down rabbit holes that aren't of any interest to me, but I want to be focused on the job in hand. In this case, it's, hey, how can I improve and find that blend of discretionary and systematic? Okay, so that's the objective of today. Let's get rolling. So first of all, let's run through quickly some definitions and what we're talking about, so we're all on the same page. What is a systematic trading system, trading strategy? Maybe that should have said. But basically, the way I look at it is this. You've got rule-based decisions. There's no discretion in it. It's like an algorithm. It's a binary event. If this, then that. Not to be confused with an automated system, right? They can be the same. And that's something where there's a program doing this, placing the orders for you using like an EA on MT4 or any of the other kind of tools out there. That's an automated system. But a systematic trading strategy or trading approach means that it's just rule-based. So, if price, easy one would be, if price breaks out of the prior high, go long, right? There's nothing to think about there. The prior high's obvious. You going long is obvious. There's nothing, of any added discretion there. It's just completely rule-based. So that's systematic, and it can be automated, but it doesn't necessarily mean you can be sitting there point and click trader saying, I'm waiting for that high to break. It's broken, I'm in. Okay, so there's that way of approaching it. So the advantages of this, and just keep these in mind for a moment, emotion-free trading to a certain extent. And what I mean by that is, it's not a panacea. It's not perfect, right? You can't just go, well, I'm going to follow the rules and I'll have no emotions, because you're still going to feel the emotions and the ups and downs of your P&L, your equity curve, your performance, your kind of stagnation, runs of strings of losers, the euphoria, strings of winners. That's still going to get you a human being, right? You can separate yourself a little bit with automation. I'm not going to go into automation today. That's not my wheelhouse, so I won't be covering that. But you can do a little bit to a certain degree, but you're still going to see your P&L, right? So you'll still have an emotional attachment to things. But what I mean is that you're not there sitting and wanting to click and you see something and I've missed it, or you've jumped in late, and that can fuel those emotions that we all know we get as traders. You can get revenge trading, you can get FOMO, all these type of stuff that can ignite poor performance in you. So something to bear in mind, because this is quite a good way of getting around things. You're not second guessing things. It's a very binary thing. If this, then that. So if this breaks this level, do that. If this touches that level, do that. If you get this, then do that. There's so many things. I'll give you a few examples in a moment. It's a very simple process. Now, one thing that is nice about being very systematic in your approach is that you have your trading rules. And let's say for simplicity, and we're going to go way more complex than this, but let's say for simplicity, it is breaking the prior day's high, right? Very obvious thing to do. If this, then it's either it has or it hasn't. You can gather data far better, so you can go back and back test, and that might not be going through and using a software or tool. It might be eyeball. It's okay to go back, and some of the hardcore algo guys are like, oh, you can't go back and look, just by eyeball. You need to go back for 5,000 years to make sure it's robust. Well, okay, if that's what you want to do. I think it's okay to go back over a series of 10 days, 5 days, 20 days, 30 days, a year with your eye and go, how would that have worked? And start to gather data. So you can do that. And also from a journaling perspective, guys, it's far better knowing that, hey, those are the rules of the system. Those are the results and the performance I've had from the system. How can I make some tweaks and adjustments to improve the system? So you know that you've followed the rules to the letter. Hopefully you have. You know that you've done this and the outcome was this. So now if you did this, a little tweak, maybe that's a little bit of a tighter stop, maybe that's a little bit more size, maybe that's waiting a little bit longer, maybe that's adjusting little tiny things, right? How would that have affected the performance? So it's much easier to gather data that you can then use to make those course corrections, to make those adjustments. Okay, so those are some of the advantages we have with systematic trading. The downside, of course, is you've got rigid rules. You're totally inflexible to current conditions. You can't adapt to the current conditions. And you can, if you're building the system based on historic moves, you're going back and you're saying what would have worked then, you kind of curve fit it, or overfitting, as the algo guys like to say, based on that data. And you're not looking at the bigger picture. Now, I guess this is a complete other going off piece here, but if you are building a system, if you are building a strategy, it's far better, in my opinion, to have it based on a thesis or a hypothesis, and then you add layer rules in. So if you said, hey, I believe that trends are the first pullback in trends is often bought, and we kind of close at highs on this type of day, whatever it might be, you then would make a system based on that, and then you go back and test it, rather than looking at the price and looking at all the charts and saying, well, how could I have done that? How could I have done that? I think there's a slight subtle distinction there. Okay, so some examples of systematic approaches or rule-based approaches. There's 3 for you here. One you may not have heard of, 2 you may not have heard of, 1 you probably have. And again, I've just used very relatively simple structured ways to approach the market. There's so many systematic trading systems out there that I've got to pick a few, right? And these are some that I actually quite like to trade anyway. So the opening range breakout, 6 o'clock shock, and 5 SMA momentum. I'm going to share with you some of the charts to kind of go through those. And this is not to explain these. And actually, if you go back and have a look at some of my previous webinars, I have covered these specific ones in more detail, which is why I did include them today, because you may be familiar with them. But it's an example of a systematic approach. And we're going to go through this process, and then we look at the hybrid and the blended approach as well. Okay, so whoops, a couple of slides ahead. So opening range breakout, you may well have heard of this type of trade. You bracket the opening range, whatever that might be. Some people use 5 minutes, some people use 15, some people use 30. You trade a break of that range. You put a stop, sometimes half the range, sometimes the whole of the range. You have a fixed target. The point is the rules, right? It doesn't matter. I'm going to go through all the permutations of an ORB, but use a very fixed rule. If it breaks this level, you get short. If it breaks that level, you get long. Your stop is here. Your target is here. It's up to you what those targets are. You might have a percentage of the opening range. You might have it an ATR. You might have it a fixed RVR, whatever it might be, right? But it's very, very fixed rules. There's no room for discretion. You take it, and the rules are very, very clear. If it breaks, you take the trade. If it doesn't, blah, blah. You kind of very, very structured with that. Okay, so 6 o'clock shock is something that I hate using the word I came up with this. It's nothing spectacular, guys, but it worked very, very well for a period of time. Not so much at the moment, but it will come back. It will come back. I know it will. This is when I was looking for an ignition bar, and the rules are it has to be after 6 o'clock. You have to have a biggest, higher than the average range bar against the trend, and your target is VWAP. So again, a very rule-based approach. One more for the rules. This one's one of Linda Raschke's favorites, the 5 SMA momentum. She looks for 7+ closes above the 5-period daily moving average. And then she would look to get long on the first close below and then close that trade on the first close back above. So run through these quickly. And it's not to kind of, go through the depths of these strategies, but it's just to give you an example of, what a rule-based system looks like. This is very rule-based. You have to have that amount of closes above the moving average. Then you go, okay, fine. Then you have to have a close below the moving average, and that gives you long at the close of that bar. And you exit the trade when the price goes back above the moving average, and you'd have a stop loss system as well. Very, very clear, rule-based. There's no room for ambiguity there. It's a systematic way to trade the markets. Okay, so hopefully that's clear. Hopefully we get that. There's no looking, second guessing this. This is rules, algos. The outcome is yes or no. All right, so let's define quickly what is discretionary system. So discretionary system is where you're making a decision based on your judgment, your intuition, and hopefully your experience, okay? You're very flexible. You adapt to real-time conditions, and that's probably most of you here. That's probably you. You probably go into the day, hopefully you're prepared. You watch the market, you adjust and adapt. You see the price movement. You say, hey, I think there's some momentum there. I'm going to jump on that momentum. Hey, I think that move's exhausting itself. It's running out of steam. I'm going to trade mean reversion. And those are kind of the ways that you trade. Okay, and that's most of the time for many traders, it's based on pure discretion. I think there's a better way, but this is a reasonably good way to trade if you can get it right. So the advantages, of course, are that you can react to changing conditions. Right, if something kicks off, if something suddenly happens, today's kind of a good example, right? The Nasdaq just started ripping off, faked out through that low and just ripped. If you're a discretionary trader, you might have jumped on the momentum and kind of rode that up, as high as you could. And it was a very distinct move. We didn't even see that in the Dow. Could you have made a rule for that? Maybe you could, but you'd have to have so many rules. It's very tricky and hard to build a systematic strategy around something like that. Sometimes when you're in front of the screen, it becomes very obvious. That's momentum ignition. I want to get on that. I can quantify a risk with the stop. I've got an obvious target. That's worth a go to me. I can see how I can structure the trade for the best outcome. So, you can react quickly, and that's important. You can take into account new variables, right, that you may not have done with a systematic approach. So that 5-period SMA trade that Linda likes to do, Linda Raschke does, and you can definitely go and look at her material. That is very systematic. It doesn't take into account anything else, right? There's no, was that based on a catalyst that caused that drive? Have we got an important news piece coming up? Is FOMC coming up? Is it non-farm payrolls coming up that might upset how that system performs? Would you really want to take that on the Thursday when you got data on the Friday? Things like that. Unless you've coded them into the system, it's very difficult to take that into account, right? Whereas if you're a discretionary trader, a screen trader, you and I both know we're there. We go, we've got Fed coming up tomorrow. We've got CPI. I'm going to take it steady. I'm not going to kind of look for breakouts. Maybe market could be a little bit stagnant. And post CPI, all these kind of data points that are important at the moment, that could cause a reversal. That could cause a new trend. So you position yourself accordingly, knowing that variable is having an impact. You can be flexible, you can adjust your position size, your trigger criteria, and you can capitalize on stuff that just you can't even allow for. Okay, to a certain extent, maybe you could. I mean, obviously anything could be coded up right into a system, a rule-based system. But when we had in August that big sell-off based on the carry trade liquidity dip, as I call it, that was something that you could capitalize on as a trader. You could see that. You could see that exhaustion, say that's worth a go. You probably wouldn't have had a system for that. So those are the advantages. Now, the disadvantages are pretty much as you know, right? You very, very susceptible to emotional influence. Um, if you're a trader who's struggling with discipline, then it can really kind of widen that chink in the armor, so to speak. Because if you get a trade wrong, you get frustrated, you get another one wrong, you get annoyed, you get another one wrong, you get angry, you could trade on tilt. And we've probably all done that at some point or the other. And it doesn't matter how powerful your strategy is, if you're trading on tilt, you're just going to screw it up. It's just not going to work. Inconsistent results is another thing. You can't backtest the performance. When I say inconsistent results, one day you might be trading on the close of the bar, next minute you might be trading intra-bar, next minute you might wait for a X point pullback. You might adjust based on conditions, and it's difficult then to kind of get the results, this consistent results, because you're changing, ever changing based on what you believe is the correct thing to do. And you also can't really back test it because there's no set rules that you can go back and say, I would have done this. That would have been a winner. That would have been a loser. Okay. Because you just would have done different things. Now, you can go back to a certain extent, but you've got a little bit of hindsight bias. It's tricky, right? We know it's tricky. You've got to see in front of the screen. Obviously, that only applies if you're trading with an algo stuff. Not necessarily, because you can sometimes be setting alerts and say, hey, I only want to trade a break of the prior high, for example, and you could quite easily set an alert now. And by the way, TradingView's got some pretty cool alerts now. Then, if you've looked recently, Trader was showing me the other day, they've got stuff like laughing man, they've got stuff like sexy and all sorts of stuff. So it's quite interesting. Anyway, by the by, you can really set things up so it's much less intensive than sitting there waiting for a setup and trying to see a pattern for you. And of course, it can lead to overtrading. We've all fallen into the trap where we have overtraded one time or another, right? So start to get some ideas of the pros and cons of both. Okay, there's no perfect scenario, I don't think, but it's worth looking at. Okay, so discretionary examples, and again, we're not here to kind of go through examples too much, but an intraday flush out scalp, a breaking news Momo trade, and a fake out under a key level. Example might be here, fake out under a key level. That's just a level from the middle of the night. You're in the middle of the night. Obviously, the Asian session's in full swing there, so fine, but very difficult to kind of pre-plan for that. That flush we had the other day on the DAX at the open, a little bit of news came in, big flush, big volume, very difficult again to know where that's going to occur, the time that's going to occur. Yes, you could maybe put some rule-based in, but you get the point. You had to be at the screen to take advantage of that opportunity if that's your wheelhouse, if that's what you're trying to trade. A very discretionary-based approach. That was the last one. I think I had one more. Okay, that's it. Fine. What was the other example I had for you? Fake under key level. Breaking news momentum trade. So yeah, if you something came out and in the market you were looking at unexpected, obviously you can react to that. You can see the momentum coming and you can see the momentum shift, the supply demand and balance move in your favor and capitalize on that opportunity. So very nice to be able to do that. And that's how most of us like to operate. Okay. So foundations laid. Let's look at the next layer. So some of the traps that I see, and trading is all about traps, guys. Trading is pretty much dodging traps, trying not to sell into fresh lows, trying to see where traders are trapped that you can take advantage of, avoiding the common traps and pitfalls of developing traders. It's about trap management. Maybe that's a good name, right? I'm a trap manager. So you're one of the things you've got to really watch out for is that you're not relying too much on discretion as a developing trader. So let me explain this a little bit better. So as you start out your trading career, you don't have any intuition. You might kid yourself. We've all kidded ourselves and say, I know what. You don't, right? The intuition comes from experience, and with experience comes exposure to different market conditions. You've seen this before. You see how this play out. You've seen things multiple times. Your intuition and your experience and your judgment gives you a way better approach. So the more experience you've got, the more you can lean on that discretion, right? When you are early in your career and you are developing trader, in my opinion, this is the way that I would approach this if I was kind of starting out again. you know, rely on discretion as little as you can. You want to build the muscle, right? You want to improve your judgment and your ability to act with discretion, and you want to build the intuitive nature of trading. Fine, but if you've got not much screen time there, then you kind of have to accept that that intuition isn't anywhere near where it should be, and so but that's okay because you can lean on rule-based systems and systematic approach. Yeah, more than discretionary. More on that in a moment. That's just something to think about. Because if you're not fully developed, then it's going to be very difficult. And one thing is, if you are an emotional trader, if you have a discipline challenge, if you are one of these types of traders who struggles with the emotional impact on your trading decisions, then discretion should be removed until that's fixed. I know it's kind of maybe not a controversial thing, but maybe a harsh thing to say, but honestly, if you're struggling with sticking to the rules, if you're over trading, if you're trading with FOMO, all those kind of developing trader challenges that we all go through, and maybe you're going through right now, you want to get those boxed off, guys. You want to say that's done. Now you don't want to open the door to any of those getting worse, and discretion tends to do that. It tends to kind of, you can leverage the emotions. You can get a little bit annoyed. I got stopped out the low. I took that. I tried to force a breakout. I got stopped out on this. Then I went short, and every sort of step I took, I just was wrong, and it felt like I could have had a coin, and we're better off. We've all been there and done that, and we feel emotion, we feel frustration, we feel that type of stuff. So discretion can amplify that. So that's a trap to be very mindful of. And the other side of the coin is really that if experienced traders aren't leveraging our experience more. If you're an experienced trader and you're still trading very much rule based, that's okay if that's working for you. But you might find that actually you've got a lot of experience and judgment there that you can use. And you've got the experience. You're like, well, trust your judgment more. Now, one thing to note here is maybe a bit rusty. Maybe you need to dust off the old book a little bit, so to speak, the brain, and so that it can act a little bit more with discretion. But that's how you kind of get the outside returns on certain types of events, or possibility of outside returns on certain events. Adding another clip of size on, layering into a position. Just maybe the system is saying, okay, well, I'll come out this level, but your experience, you've got a decent amount of intuition there and judgment, and you say, well, this thing's bringing motoring. This is motoring. I don't want to take it out there. I'll monitor it at that position, but if it's flagging under that high, then there's no reason for me to take it out. That's when you can adjust and adapt, right? So those are some of the main traps. Okay. So where's the sweet spot? And what I mean by this is, if we go now into the kind of meat of what we want to talk about here, is you have discretionary system, full systematic system, right? Or fully rule-based approach, right? One is, we talked about the definitions of those. You can have 100% one, 100% the other. Okay, so but I think there's a sweet spot where you can use a blend of the two. So you use a rule-based system to guide you and give you some guardrails, give you some buffers to work within, and then you leave a chunk of that execution to discretion. Some examples in a moment, but a good way to visualize it is in these pie charts, right? So depending on your style, depending on your experience, there's a lot of context-dependent stuff there, but you may want to trade a systematic strategy with a very thin sliver of discretion. So that might be if you're trying to build that intuition up, if you're trying to work on your emotional side of trading, the mindset side of trading, you don't want too much discretion. You want a bit because you want to build the muscle, right? Just like going to the gym, you want to work the muscle so that it builds over time. You want to build it, but you don't want to give yourself too much room. And that might be, I've got an example in a moment, maybe I'll jump the gun, but that might be, hey, let's go back to a very simple example. I buy a breakout of the prior high. You might then say, that's the rule based. I buy a breakout of the prior high. There's the rules. And the discretionary part might be, I can choose whether to enter before the bar closes or on the bar closes. That's a really simple approach, but you can see how it's 95% systematic and 5% discretion. You're going to pull the trigger, you're going to take the trade, but it's up to you whether you take it at the break or whether you wait for the bar to close. There's a little bit of intuition there, and you might see it absolutely ripping, and you're like, I'm taking it straight away. Or you might be like, it's pausing a little bit. I think I can wait for it to pull back. I think I'll get a better price if I wait for the close. That's a very, very simple example of using that. And then you could shift over to the other side of the side of the slide, should I say? Well, there's a 25% discretionary element to that strategy, and let's use that as an example. You might say, okay, well, I want to get long at that point, but how much size am I going to trade? How big is my stop going to be? Where am I going to enter the trade? Am I going to wait for a pullback? There's some stuff, and you can add much more discretion in it, but you're still kind of structured in that I'm looking for a breakout above the prior high. That's the systematic part of the strategy. And now the discretionary part is much bigger. So the pie chart of the strategy you're deploying can be adjusted depending on what you're trying to do, where you are in your experience level, what your advantages, your disadvantages, say your strengths and your weaknesses. That's really something to think about. And we're going to go into more detail now, but I'll pause on this for a moment, because thinking about the blend that you want and the strengths that you have and the weaknesses you have as a trader, this can overcome a lot of this stuff. If you take a lot of that decision away from you intraday, if you are, a guy at very heat of the moment, you kind of get emotional with stuff, and you can take a lot of that cognitive load off you, the burden of performance off you intraday. You've got a systematic approach, and then you layer in discretion. That's far easier for you to do. It's far easier for you to get the results. It's far easier for you to gather data on. It's as much as it's simpler, right? And yes, okay, maybe you're going to miss out on certain things, but it's a small price to pay. Whereas if you're a trader who is very disciplined, you feel like you want some guardrails and approaches to take the trade, but you kind of the nuances and you kind of reading how price behaves, then you can go the other side of the pie chart. So here's some steps to kind of help you discover exactly the blend that's right for you. And this is honestly, this is so important, because you don't have to be in one camp or the other. You can really use and say, hey, I know that this is likely to happen. I know that on a trend day, we're likely to close at highs. So if I can identify a trend day, how do I get on it? And there's already things you know. You don't have to have every decision made at that point in time. We're about to take the trade. You know that when the market's been sitting there chopping around the open and VWAP doing nothing, taking a breakout is probably not the best thing to do. Taking a breakout at lunchtime is probably not the best thing to do. There's already many things that you know. And so you decide on your pie chart, experiences, challenges, goals, build a rules-based approach based on a tested edge or something you know to be or believe to be true. And then you layer in the discretion for specific elements of the trade. Okay, so I'm going to use an example now with John Bollinger's Thief setup. So John Bollinger, inventor of the Bollinger Band. I met this gentleman at a Pepperstone Talks event in London, and one of the things he shared, it was an event for Pepperstone clients, so maybe some of you were there. So public domain to a certain extent what he was sharing, but he was sharing what he called the Thief setup. And when the John Bollinger, the inventor of the Bollinger Band, talks about a strategy he developed with Bollinger Bands, you're going to listen, right? And even if you're not an indicator guy, even if you don't like trading that, it's still interesting. Anyway, the point is this. I'm not going to go through kind of in minute detail, but it's a very systematic approach. Okay, he has his Bollinger Band set to a certain setting. He basically looks for the price to close above the upper Bollinger on day one, close below the Bollinger on day two, and as long as the ATR or the range of both those days is above the 14-day average true range, he then takes a short. So it's an exhaustion type trade. Close above the Bollinger Band on day one, close below at day two. Got an example in a moment for you. He takes a short. So it's a very systematic approach, and vice versa for longs, right? Rule based. This has got to happen. This has got to happen. This has got to happen. If it doesn't happen, it's yes or no. It's a very, very systematic approach. Okay. And here's an example, right? So the downside, I can't remember what chart this is. I pulled this from Trading Plan Pro, but it's the downside. It closes below the Bollinger, closes above it, and both the times the ranges are above the average true range on a 14 period. So he would be long here, and he would hold that. I think he was back to the midpoint of the band or something like that. It's by the by, but you get the idea. So you leverage on the mechanical system. So if you are blending the two together, you might say, hey, I like John Bollinger's approach with his thief strategy. I think that's interesting. I think that's good. All right, so now I'm going to layer in discretion. And by the way, this could be anything. Right? I've just picked this because he was there and Pepperstone's on my mind. Obviously, we're doing this conjunction with Pepperstone. I remember shaking Mr. Bollinger's hand, having a chat with him and joking about counter channels and blah, blah, blah. But the point is it could be any rule. It could be Linda's 5-period SMA. It could be something you've come up with, opening range breakout trade, afternoon breakout trade, the momentum predator trade, any of these things that have a rule-based approach. You start with that as that's your starting point. And then you go, right, there's my pie chart. It's 100% systematic now, the thief setup, whatever it might be. Now, how much discretion do I want? And maybe you do trade it 100% automated, 100% systematic, and that's fine. And maybe John does, and that's fine. But maybe you're a discretionary trader who wants to kind of have some guardrails and be on the right side, but layer in some more edge. So if you believe this system has edge, a rule-based system, you go, right, that's a good starting point. But maybe you believe that also you have the ability to spot short-term momentum. You've got a good edge in that. That's your advantage. That's your real strength. And so you can say, well, if I can do that, I can jump on stuff, have a reasonably tight stop. And if I can layer that into the broader idea, this thief system is going to give me 2 days of move or 4 hours of move, whatever you're trading on, then you might say, actually, I can blend the two. I can have the rule base, so I don't even look for longs until that system goes ding, green light. And then I get the green light. I can then look at how much discretion I want to layer in. Okay, so an example, if we stick on that one, let's say you have the trigger on day 2. You get the close below, the day 2 closes above. Now, you might say, I've got some discretion here. I'm actually not going to buy on the close. I'm going to maybe wait for a little dip at the open on day 3 to buy, because I think I'm quite good at spotting those dips. But you've got the rules, and now you layer in discretion. Maybe you're jumping on a flag and you preempt the close. Maybe you kind of do something else in terms of, hey, well, I'll trade an afternoon break on that second day because I don't want to jump in too early, and I can really minimize the stop on that. And I can make this into a potential 10-hour trade. Maybe I can double my risk. You can adjust things, right? You could say, hey, in the right environment, let's go back. In the right environment, I want to take triple the risk on this trade. I'm prepared to do that because I feel like we're in, a bullish trend environment. Anyway, there's a discretionary element. So going back to that pie chart, you've got the systematic approach, and that was just that the rule-based approach there with the Bollinger Bands, fine. And it could be anything. Opening range breakout, afternoon breakout, whatever it might be. And then you decide how much discretion to add, if at all. Now, the objection, which is a very valid objection, is this: Mark, aren't you ruining the system by adding layers of discretion in? And my answer to you would be, you may well be. You may well be ruining the system. However, and that's up to you. Maybe you trade it fully systematic. Ding, ding, ding. Here we go. I'm in, and it's my stop. I'm just going to trade it like that. And maybe you do that. That's the type of character you are. But also, if you have the ability to read short-term supply-demand shift, if you have that experience and that judgment you can lean on, you know that it has a positive expectancy. So now you just use the rule-based systems to give you the bias, and then you time with discretion. And so very often, this is the sweet spot of saying, hey, I've got an edge here, but I'm going to add to the edge because I don't want to risk a whole day's worth of trade there. I want to try and find something intraday on that long side that really helps me kind of maximize the profit from this deal. Okay, so let's talk about some discretionary based elements of a trade. So the final yes no decision, do you even take it? Or maybe you don't take it. Maybe you decide not to take it because it's near to highs. Maybe you don't take it because you've got data tomorrow. Maybe you don't like whatever reason, right? Again, you can trip yourself up a little bit here if you're not careful, but that's one way you can do stuff. Some sizing adjustments. Is that a grade A plus trade? Do you want to be risking more on this deal versus the prior one? Maybe you do. When to enter. We talked about how to adjust that. Maybe you want to enter on an opening range break, a little flick down, a little fake out the open, afternoon breakout. Any of these type of things, right? Maybe you want to add, and adding to the trade and pyramiding into the trade is a discretionary based approach for you. In which case you say, right, okay, I'm going to get in, and now I'm going to look to add to the position. I'm going to use my judgment based on that. You're probably not going to add after it's stretched right at highs. You're probably going to wait for it to come down, find some support, maybe dip below that support, find a bid. Okay, there's my add. There's my stop below the level. You kind of work the stuff that works into the rules that you've already got. Maybe some of your targets are kind of rule-based as well, or discretionary-based, should I say. Okay, so I've included the slide to kind of really put into words the type of things you might look for as a discretionary trader, or the type of discretionary elements you might blend into your systematic strategy. And by the way, before I go and we talk about this too much, the reason we often want to use a systematic guardrails is that there's stuff that is often true regardless. Like, if you're trading intraday, if you're an intraday trader of, DAX, let's say, or Dow, very often lunchtime it can drift around a bit. Your market can drift around, it can get choppy. So you know that every day you probably don't want to trade a breakout at lunchtime. I'm using a hypothetical example here. And so that could be a guardrail. It's like, okay, I trade this, but I have a rule in place that says I don't trade that this time. And you might say, hey, actually, after a narrow range, we've gapped up. If we kind of faked to the gap fill, then I want to take the trade because I've seen that happen time and time again. But I only take it up to an hour after the open. Because after that, we run out of steam. There's guardrails. So the systematic approach is really just applying guardrails that you can operate within. It can be as wide as you like. You say only trade for the first 2 hours. That's just a guardrail. It's not necessarily giving you direction, but it's still acting as some kind of constraint. I only trade this market within these hours in this direction. Okay, and maybe you do that just because you know that there's the advantage to be had there. Okay, so ideas for or discretionary based examples. After a flush, you get good at spotting the incoming support. So I know traders who are very, very good at spotting the flush. They see the pop, they take the trade. That's their edge. And now they might layer that into a systematic approach that says, hey, well, the edge is I'm getting long on this day because the system says to get long, but I'm going to wait for a flush on the day because I really want to have a user tighter stop, and I'm using that layer of edge, and I'm using my discretion, and I'm blending them together to get the perfect combo. Maybe you're good at spotting momentum after a flag. You see the flag, often you see a flag come, it kind of dips, and then it starts to rip. You know that feeling, you've seen it, that momentum ignition within the flag concept. Maybe you're good at that, and so you layer that into something that wants you to get long that day. And maybe, again, you're just good at kind of spotting short-term supply-demand shift. So let me share with you some best practices. So hopefully this has made some sense so far. Again, there's a Q&A section, Q&A if you'd like to ask questions. Of course, I'm very help you out if I can. We'll go back through some slides that maybe I run through too quickly, don't understand, but we've not quite finished yet. Best practices. When you are adding or blending together discretion and a systematic approach. And by the way, I know from my trading, I have a selection of trading strategies I deploy. Some are fully systematic, some are fully discretionary, and many are a blend of the two. And many that pie chart looks different depending on what it is. So there's some strategies that I know, hey, this is very systematic. You don't need to add much discretion into this. You might not get it very often, but you need to take it per the rules, and you have a little bit of judgment there. Others might be, you know what, I know that I like this type of thing, but I really got to kind of watch it and see. I don't know how far it's going to push. I don't know how much mileage we've got to the downside, what time of day. Those are the things that are important to me. So you could say that's fully discretionary. So it doesn't always apply to every trade. Every trade sets up a strategy, but you can build the strategies around that idea of, okay, here are the rules, here's the discretion. And again, going back to that point of what are you trying to achieve? You're trying to take the burden of performance and pressure and cognitive load off you. You want much more rule-based. If you're trying to capitalize on your experience and your judgment and your intuition, you want more discretion-based. And finding that blend that's right for you is really going to unlock a different level of trade. It's going to make things easier and calmer. And sometimes you go, well, I can't make rules for this, Mark. I'd like to see this. You probably can. You probably can add more guardrails that take the pressure off you and say, well, all I've got to do now is find a good place to get long at this point. I know I want to get long. The rules tell me to get long. The time of day is right. The distance from VWAP's right. The pattern's right. I've just got to judge it. That's far easier than saying, is it long? Is it short? I'm doing this. Am I doing that? You're giving yourself some constraints to work within. So take some good notes on your performance. Which parts of the trade were rule based and which were discretion? So this is like if you're building your own playbook here, and keep track of the decisions you are making on in the heat of the moment. Are they serving you or are they not? In other words, if you're leaving, let's use that really simple example of a break to highs, and you're looking to buy either on the close of the bar or intra bar, you log down. Hey, I bought intra bar. It wasn't that great. That I should wait. You kind of log the decisions you're making and why you're making it and the reasons you're making that decision. And then you look at the data and go, are those decisions serving me or are they not? And you only really know that when you log down the decisions and you note down why you're making the decisions and you note down the results of the decisions. Otherwise, you'll really struggle because you go back and look through your data, you mark up your charts and go, well, I don't know if I did that. Did I buy the close there? Why did I do it? And you don't know what you're doing. And often you go, actually, that decision is not serving me. I need to eliminate that aspect of discretion from this setup. It's not serving me whatsoever. I will fix it or I will buy on the bar close because having this hairy fairy, not knowing what I'm doing, it's not working for me. And so then you know, well, those resources, that mental capacity, where can I deploy that? What's better? Well, actually, you're better going into the trade on a very systematic basis, and then you're better exiting the trade on a discretionary basis. You know, there's so many levers you can pull. There's so many games you can play, and it's about adjusting and adapting and finding the combination that suits your mental capacity. It suits your experience. It suits you as a person. It will change over time. It changes with context. It changes with conditions. It changes with setup. Absolutely. But that blend, getting that blend right, it makes trading so much easier. So much easier. Is it a panacea? Is it going to work flawlessly? Absolutely not. But it makes life easier for you. You don't get so stressed or so anxious in a trade. Okay, so over time, this is what you kind of build. You build a selection of rule-based systems for specific circumstances. You build discretionary tactics to get into those trades, and then a selection of themes and guardrails. So let me go into explain this a little bit better. So you have these rule-based systems like John Bollinger's Thief strategy, like Linda Raschke's 5 SMA, like the ORB trade, like the afternoon breakout trade, anything that's rule-based, okay, under specific circumstances. So when this, and this happens, you do this. So you build that suite and selection, and you can't start to store them, you document them, you put them in your Google Drive, you write them down, whatever it might be, and those are there. And then you build discretionary-based tactics that help you trigger into trades. So exhaustion, right? Exhaustion, you want to see a good heavy move after extended down day. We've talked about these before. Flush, volume, blah, blah, blah. Fine. That's a discretionary tactic. It doesn't really work on its own. It has to be used in conjunction with the position of the market, where the market is, the time of day. There's other stuff that comes into it. Maybe you like to buy a pin bar through support. Maybe you like to buy a bull flag. Maybe you like to sell into fresh low. There's these tactics and I guess price action rules that you have that sit there again standalone. And you've got these suites of rule-based systems. Okay, now number 3 is you have themes and guardrails. Oh, I'll never take a trade that's above the ATR. Oh, I'll never trade during FOMC. Oh, I'll never trade at the whatever it is. So now you blend them all together and you say that's a rule-based system. I can time that with this discretionary tactic. Like I'm very good at spotting bull flags, or I'm very good at spotting those flushes. Bolt that into a rule-based system that I believe is effective, like the 5Fs, whatever it might be. There's millions out there. Yeah. You bolt them together and you go, that's what I want to do. I have a little bit of discretion. I have a rule-based system. I have guardrails in place. Okay. So what's next? Some things you can do. Work on your plan. Have a look at where you need rules and where you can be flexible, where you can add discretion and where you don't want discretion. And that comes from the North Star of what am I struggling with? Is it strategy, efficacy? Is it discipline? There's one of those two normally that's stopping you from moving forward. So if you decide the rules, where they need to be deployed, how you can apply the guardrails, then you can trade. And then if you think about, if you go bowling, right? You go bowling, you can have those gutter rails come up. And if your kids go and you go, right, well, they're going to in there because they're going to have the worst day ever because it's going to bounce off. He just bounces off and they go, oh, I got a strike. You go, oh, well done. But if they didn't have those in there, it would be a really bad day because every single ball will go down the gutter. And, the beautiful thing is with trading, we can have those guardrails. We can say, you know what, I'm just not going to trade during that period of time. I'm going to just prevent myself from getting even having a chance of going down the gutter because the guardrails are up. So thinking about that, what rules you need to be and where you can be flexible in your different in your selection of trading strategies, how you can leverage data versus experience and intuition. So that's going to be your pie chart. So data on back testing and coming up with ideas and strategies and systematic approaches. We talked before about using Chat GPT for stuff like that, researching strategies, finding systems, coming up with systems, coming up with that systematic rule-based approach, and then leverage experience into that. So data, experience, beautiful combo if you can get it right. Talking about your lifestyle constraints. So this is a kind of real oddball question, but what I mean by this is if you are unable to be at the screens during the open, then you're not going to be able to trade the opening range breakout with a discretionary based entry. You may be able to set your orders and you're like, hey, I can set my orders after 15 minutes. I can set my orders and leave it, in which case it's fully discretionary. You don't add something that's going to really stress you out. I've got to get to the screen. I said I'd take a flag after it broke out, but I'm doing this. I've got to. They're just silly. You're never going to be able to get anywhere with that. So think about the constraints you've got, the time you've got to trade, how much then needs to be systematic, how much needs to be discretionary. Your own challenges, your own weaknesses, your own strengths, what you're good at, what you're not so good at, and that sweet spot, as in the sweet spot of the pie chart, the discretionary slither, will change over time. And it will change with the market conditions, and it will change with your objectives, and it will change with your challenges. There's a time when you could trade almost systematically with that big bull run. You could say, I buy under prior day's close a strong stock, and then it will go your 3-day run out of it. You could literally systematically approach the market. Now it's a little bit more nuanced. You have to layer in some discretion. You have to kind of look at things a little bit differently through a different lens, but you build your playbook based on that. If you are struggling with discipline, it's a good time for me to mention I have a Google Sheet available for you. You can copy it. You can just go to tradersmastermind.com. Top right, I want to say, discipline tracker download. I built this for myself. I shared it with a few trainers. They were like, this is really good. This is helping me with my discipline. So it's available to you. You just need to give your email address, share your email address, and I will send that to you and you can copy that. So if you're struggling with discipline, this is well worth checking out, and it's Google Sheets as well, and it runs on obviously any Google account. So that's a good thing to check out. Okay. That's it, ladies and gents. I will take some questions now. If you have any questions, let's have a look. And I just want to put that pie chart back up because I think that really was the kernel of what's important with this webinar. All right, let's have a look. Okay, ladies and gents, thank you very much for your questions. Rowie is back. You are a regular here, Rowie, and you're always getting involved and asking questions, so I do appreciate that. Anybody operating live and asking questions, appreciate you being here. Okay. Hi, Mark. Great and correct webinar. Thank you. Since I mix between the two, it really serves me. Thank you. And you're saying last week, it's interesting that you mix between the two as well. I think that having that in your mind and saying how much discretion, how much rule-based am I trading, really does help. Last week I took your advice about trading the DAX market in the morning instead of the NAS pre-market. It feels much better. Thank you. Your stuff always has something good. Appreciate that, Rowie. And you're the one taking the action. You're listening and saying, okay, some things and don't really not interested in some things. You go, I'll try that. And you know what? Trading is about feeling more comfortable. Trading is about if you feel a sense of peace in your trading, regardless of your P&L status, that's a nice place to be. You can still be a developing trader and trying to move forward, trying to improve, but you can also be saying, you know what, actually, I like the way I trade. It fits around my lifestyle. It fits around, I feel good about it. And there's a certain peace that comes with that helps you move forward with much more momentum and get to where you want to go quicker. So it's good that you feel that. And actually, if anyone's listening or watching this and they're saying, hey, I don't feel that, I feel anxious about trading, then something's not right. And yet maybe your P&L is giving you that anxiety. That's fine. But often it's not. Often it's, I don't feel comfortable with the way I'm approaching the market. The strategy is ineffective. I feel rushed. I feel stressed. And trading shouldn't be that way. It should be a much calmer approach. Yes, I know we're risking capital. Yes, I know risk-based decisions can, evoke anxiety, right, in people. And you kind of get a little bit more seasoned to that as you go through your trading career. But If you are feeling uncomfortable, go back to basics and go, can I make some adjustments? Can I change some things that I feel a little bit better about how I'm deploying capital in my trading plan? And Gary finally here has said, he wants to say thanks, appreciate you, Gary, and he likes the approach of a hybrid. I think the approach of hybrid is very sensible. Does not have to be a binary choice between one or the other. Yes, I think you're absolutely right, Gary. And to further that point, I think that's the same with all trading. Some people are like, I'm a day trader, I never hold overnight. I'm a swing trader every day. You're a trader. Your job is to spot supply demand imbalance. Now, sure, as you're developing, you might say, I'm just going to focus on this for now. But at some point you go, well, why would I not hold this trade a little bit longer? Why would I not kind of look to trade in a slightly different way? Why would I not go to where I feel there's more opportunity? I think that's key. So yeah, not always planting your flag in the ground and saying this is the type of trader I am, because market changes, life changes, etc. Okay, so thank you, Gary. So Kadrin says, what advice do you have on blending aspects of algorithmic systems and discretion? Hey, Kadrin, what you can do, it's funny, we had this conversation with traders yesterday. You can have an algorithm trigger the trade for you, and then you decide, and then you manage it. So that's one way of doing it. You say, hey, it's a systematic approach. The algo triggers the trade, gets me in the trade, alerts me, and now I have to manage it. And so then you can say, right, do I want to hold this trade? What's my target? How can I trade this type of thing? Or you have the algo manage an exit for you. So you get in the trade and you say, right, and to be fair, I know it's not really an algo, but even like a trading stop is a kind of algo to a certain extent. That's managing the exit for you. I know it's not what you asked, and I appreciate that's not true algo, but in a way, that's kind of managing the exit for you. So I think you could do a little bit of both. And you could maybe even like adjust the position size. There's kind of ways and means of doing that. I guess the true algo guys will go, oh, you've got to run it and leave it systematically to run the algo and don't get involved in it. I get it, but I think that there's edge to add a little bit of discretionary flavor to stuff. And okay, yeah, you don't want to ruin a system by meddling. That's not what we're talking about. You're not talking about meddling and stuff. We're talking about if you have edge and you have some intuitive nature and you have some good judgment, how do I use that to your advantage? That's a very different thing. Okay. Another one's coming here. Pascal says, well, it's my first time here. Will certainly come back. Well, you're very welcome, Pascal. Thank you for coming in. Thank you for the feedback. He says, thank you for the simple explanation. Have a good evening. That was just some positive feedback. I'll take it, Pascal. I'll take it. Thanks so much, pal. All right, ladies and gents, we should call it an evening there. I think that is everybody. Have a good trading rest of the day if you are trading. Have a good trading week. We'll be back with another webinar next week. And I think we're on to psychology. Maybe not next week, the week after. But anyway, always good stuff. I try to give you the best possible value that I can. And hopefully this one was no different. Take care. See you soon. Bye-bye.